Today's tax tip is a page right out of our book called How Do I Eliminate a Tax? And for some business owners, taking advantage of this deduction requires a little planning. But sadly for a few, there is no planning that can capture this deduction. I am talking about the Qualified Business Income Deduction, or QBI. Simply put, the QBI deduction is a whopping 20% reduction of the income you claim from your S-Corp, LLC, partnership, or sole proprietorship business, subject to a few limitations. You don't want to miss out on this one if you can help it. Let's first address those few limitations. Your deduction is limited to 20% of your taxable income on your personal tax return and 50% of your wages paid to employees, including yourself, or 2.5% of your original cost of all your fixed assets purchased as claimed on your business tax returns. Let me show you one quick example to illustrate how big of a deal this is. Let's say your business earned $500,000 this year, and that same $500,000 also is your taxable income on your personal return. So as long as you paid at least $200,000 in wages to your employees and yourself, you're eligible to deduct up to $100,000 or 50% of those wages off your personal taxable income. Given that income, you save about $40,000 in federal and state income taxes on that $100,000 deduction. We don't want to lose out on this one, so if possible, let's make sure you have wages equal to at least 40% of your total profit number to max this deduction out. If you are a real estate holding company and have no wages, we will use 2.5% of your building's cost to attempt to maximize this deduction on your rental income. But there is a catch. For some of you, if you fall into a few specific business industries, the IRS caps the ability to claim this deduction when your personal adjusted gross income exceeds $170,000 for single filers and $340,000 for married filers. I've listed these industries on the screen. Take a look and see if your industry is on the list. If it is, we would still love to find a way for you to qualify for this deduction, but our planning options are severely limited. Given there is limited ability to reclassify your industry to something that is not on the list, the primary goal here would be to reduce the income that is hitting your personal return from your business in an effort to keep you under the income thresholds. Options to accomplish this are: 1. Bring on the partner in the business you have been considering. Doing so would shift some profit dollars to a different household, potentially bringing you under the threshold. Or 2. Gift a portion of your business to your children. While your children would be subject to paying taxes at the same tax rate you are, we could potentially grab the 20% deduction by spreading the income to other household members that file their own tax returns. Naturally, there are a lot of things to consider before making either of those moves, but if you are at risk of losing the valuable deduction, it could still be something we ought to look at. Also keep in mind, this deduction is over in 2026. As always, let us know if you need to chat about this or any other topic. Thanks for watching.